October 22nd, 2025. I was reviewing quarterly asset allocation reports when I noticed something that made me double-check the numbers 3 times. BlackRock, the world's largest asset manager controlling $11.5 trillion globally, had quietly reduced their US dollar-denominated holdings by $2.1 trillion over the past 18 months. Not all at once, not with any public announcements, just a steady, systematic reallocation that represented the largest capital exodus from America since the end of World War II. But here's what made this truly extraordinary. They weren't alone. Vanguard had moved $847 billion overseas. State Street had relocated $623 billion to non-dollar assets. Even smaller regional managers were following the same pattern, quietly diversifying away from the currency that had dominated global finance for 80 years. My friend Sarah, who works in institutional portfolio management, put it perfectly. It's like watching the smartest money in the world quietly heading for the exits, while everyone else is still enjoying the party. They're not panicking, they're not making dramatic moves. They're just leaving. And that's what scares me most. The numbers told a clear story. This wasn't market rotation or temporary rebalancing. This was systematic capital flight by institutions that manage the retirement savings, pension funds, and endowments of millions of Americans. The people responsible for protecting long-term wealth were betting against the very system that created that wealth in the first place. What this really means: the silent vote of no confidence. When BlackRock moves $2.1 trillion out of dollar-denominated assets, they're not making a political statement or trying to manipulate markets. They're making the largest financial bet in human history that the U.S. monetary system is entering a phase where holding dollars becomes more risky than beneficial for their clients' long-term wealth preservation. The scale of the movement. To put $2.1 trillion in perspective, that's larger than the entire GDP of India or Brazil. It's more than the market capitalization of Apple, Microsoft, and Amazon combined. BlackRock didn't just reduce their dollar exposure. They moved an amount of capital equivalent to a major economy away from American assets. But the movement wasn't random. Analysis of their quarterly filings shows systematic reallocation toward European real estate, Asian infrastructure bonds, commodity futures, and precious metals. They're not betting against America because they hate America. They're betting against the dollar because mathematics suggests it's becoming a poor store of value. The institutional cascade. When BlackRock moves capital, other institutions pay attention, not because they necessarily follow BlackRock's strategy, but because BlackRock's research capabilities and long-term track record suggest they see trends before others recognize them. The cascade effect is already visible. Norway's sovereign wealth fund reduced dollar holdings by 23% in 2025. Japan's pension fund has quietly diversified into won and euro-denominated bonds. Even small regional pension funds in states like Oregon and Wisconsin have begun geographic diversification, initiatives that reduce their exposure to domestic dollar assets. The client protection imperative: BlackRock manages money for teachers' pensions, university endowments, and retirement funds that ordinary Americans depend on for their financial security. When they reduce dollar exposure, they're essentially telling these clients that holding dollars long-term poses risks to their financial well-being. This isn't speculation or market timing. This is risk management by institutions that have legal fiduciary duties to protect client wealth over decades, not quarters. The historical context. No reserve currency in history has survived the combination of unsustainable debt growth, persistent inflation, and loss of manufacturing competitiveness that characterizes the current American economy. BlackRock's capital movement suggests they understand this historical pattern and are positioning accordingly. The 3-stage collapse pattern we're witnessing. History shows that reserve currency collapses follow predictable patterns over 15-25 years. Understanding where we are in this cycle explains why sophisticated institutions are quietly repositioning capital away from dollar dependence. Stage 1, overextension and complacency, 2008-2020. The reserve currency country leverages its monetary privilege to finance consumption beyond its productive capacity. Debt levels rise, but international demand for the reserve currency masks the underlying problems. During this phase, the dollar's international dominance actually increased despite America's growing debt problems. Countries continued accumulating treasury bonds because no credible alternatives existed. The 2008 crisis temporarily increased demand for safe dollar assets. Stage 2, early warning signals, 2020-2024. Sophisticated observers begin questioning the sustainability of the existing system. Inflation appears, debt service costs rise, and alternative arrangements begin developing. But public discourse remains focused on short-term issues rather than systemic problems. We saw this phase clearly after 2020, when massive money printing caused inflation while China and Russia began developing alternative payment systems. Most Americans focused on post-COVID recovery while institutions quietly began diversification strategies. Stage 3, silent capital flight, 2024 present. Professional money managers begin systematically reducing exposure to the reserve currency while maintaining public optimism. This is where we are now. BlackRock's $2.1 trillion reallocation represents the beginning of Stage 3, where smart money leaves quietly before retail investors and ordinary citizens recognize what's happening. Stage 4, public recognition and panic, coming 2026, 2028. The capital flight becomes obvious to mainstream observers, triggering desperate policy responses that accelerate the decline. Currency controls, emergency measures, and political scapegoating characterize this phase. Stage 5, replacement system emergence, 2028-2030. A new reserve currency or system of currencies emerges, typically led by rising powers with stronger fundamentals. The old reserve currency becomes one of many rather than the dominant global medium of exchange. BlackRock's quiet exodus suggests we are transitioning from Stage 3 to Stage 4 faster than most analysts anticipated. The mathematics behind the exodus. Understanding why BlackRock is moving capital requires examining the specific financial metrics that make dollar-denominated assets increasingly unattractive for long-term institutional portfolios. The debt service trajectory. U.S. federal interest payments reached $1.4 trillion in 2025. Roughly 28% of all federal tax receipts consumed just paying interest on existing debt. Mathematical projections show this rising to 45% by 2028 and over 60% by 2030 if current trends continue. No country in history has sustained debt service costs above 40% of tax revenues without either defaulting, inflating away the debt, or implementing severe austerity measures that destroy economic growth. The currency debasement acceleration. The Federal Reserve's balance sheet expanded from $4.2 trillion in 2020 to $8.9 trillion in 2025. This represents a 112% increase in the monetary base in just 5 years, the fastest peacetime money creation in American history. For institutions managing long-term portfolios, holding assets denominated in a currency being created at historically unprecedented rates represents a guaranteed loss of purchasing power over time, the productivity decline. Reality. American productivity growth has averaged 0.8% annually since 2010, while government spending has grown at 4.3% annually. This means the economy's ability to service debt is growing slower than the debt itself, a mathematically unsustainable trend. BlackRock's models likely project this productivity debt divergence, leading to either currency devaluation or economic stagnation that makes dollar assets poor long-term investments. The international demand shift. Central bank purchases of U.S. Treasuries fell 67% in 2025 compared to 2020 levels. Meanwhile, international gold purchases reached record highs. This suggests global institutional investors are reaching similar conclusions to BlackRock about dollar-denominated assets. The alternative return opportunities. European infrastructure bonds offer 4.8% yields with better demographic fundamentals. Asian development projects provide 6.2% returns with faster economic growth. Even commodity investments offer better inflation protection than dollar bonds yielding 4.1%, while inflation runs 3.8%. From a pure risk-adjusted return perspective, dollar assets are becoming less attractive than alternatives for the first time since the 1970s, where the $2.1 trillion actually went. Analyzing BlackRock, the specific asset reallocations reveals a systematic strategy for preserving wealth during monetary transitions, rather than simply avoiding dollar exposure. European real estate and infrastructure, 31%, $651 billion. BlackRock dramatically increased investments in European commercial real estate, renewable energy projects, and transportation infrastructure. These assets provide inflation protection while generating yields in euros, which have better fiscal fundamentals than dollars. The European investments focus on Germany, Netherlands, and Scandinavia, countries with aging populations that create stable demand for infrastructure services, while maintaining stronger government finances than the United States. Asian development and manufacturing, 27%, $567 billion. Major allocations went to Asian infrastructure bonds, manufacturing partnerships, and supply chain investments concentrated in Vietnam, India, and selected Chinese projects that don't face U.S. sanctions risks. These investments provide exposure to the world's fastest-growing consumer markets while diversifying away from dollar-dependent trade relationships that may become problematic as international monetary systems evolve. Commodities and natural resources, 23%, $483 billion. Significant increases in agricultural land, mining operations, energy infrastructure, and precious metals storage facilities. These hard assets maintain value regardless of currency fluctuations, while providing essential materials that growing economies need. The commodity focus includes both traditional resources, oil, gas, metals, and modern necessities, lithium, rare earth elements, agricultural technology, that should appreciate as global development continues. Alternative currency bonds, 19%, $399 billion. Strategic investments in one-denominated bonds, Swiss franc instruments, and even some gold-backed securities issued by countries building alternatives to dollar-based systems. While still a minority allocation, this represents BlackRock's acknowledgement that portfolio diversification now requires exposure to non-dollar monetary systems that may become more important over time. The cascade effect. Who else is quietly leaving? BlackRock's reallocation is part of a broader institutional exodus that suggests coordinated recognition of systemic risks rather than isolated portfolio adjustment. Sovereign wealth funds. Norway's government pension fund reduced dollar holdings from 42% to 19% of total assets in 2025. Singapore's GIC increased European and Asian allocations while cutting U.S. exposure by $340 billion. These funds manage oil revenues and national savings, making their currency diversification particularly significant. Corporate pension funds. Major American companies are quietly diversifying their pension investments away from dollar concentration. Boeing, General Electric, and Ford have all increased international allocations while reducing domestic bond holdings that their actuaries now consider higher risk than traditional analysis suggested. University endowments, Harvard, Yale, and Stanford endowments have begun geographic diversification initiatives that reduce their exposure to U.S. assets from historical levels above 70% to target levels around 45-50%. These endowments need to preserve purchasing power over centuries, making them sensitive to long-term currency risks. Insurance companies. Life insurance companies that need to match long-term liabilities are systematically reducing dollar bond exposure in favor of international diversification. Prudential, MetLife, and others have quietly increased non-dollar investments by 34% since 2024. The pattern recognition. When institutions with different investment horizons, risk profiles, and client bases all make similar diversification decisions simultaneously, it suggests they're responding to mathematical realities rather than temporary market conditions. What this means for ordinary Americans. The institutional exodus from dollar assets has immediate and long-term implications for Americans who do not have access to the same diversification options that large institutions employ. The hidden wealth tax. As institutions reduce demand for dollar-denominated assets, yields need to rise to attract remaining buyers. But rising yields on government bonds means higher interest costs, which requires either higher taxes or more money printing. Both options reduce the purchasing power of ordinary Americans' dollar-denominated savings. Most Americans hold their wealth in dollar bank accounts, dollar-denominated retirement plans, and dollar-based investments. As institutions diversify away from these assets, ordinary citizens become increasingly concentrated in the assets that sophisticated money managers are avoiding. The employment implications. When capital leaves America for higher return opportunities overseas, it creates jobs and economic growth in those overseas locations rather than domestically. BlackRock's European and Asian investments will likely generate more employment in those regions than comparable domestic investments would create in America. This capital exodus contributes to the financialization of the American economy, where domestic investment focuses on financial engineering rather than productive capacity that creates well-paying jobs for ordinary workers. The retirement security crisis. Most Americans' retirement security depends on 401k plans and pensions that are heavily invested in dollar assets. As institutions like BlackRock diversify internationally, ordinary Americans become increasingly concentrated in the assets that professional money managers consider riskier. The average American retirement account is 73% invested in U.S. assets, while sophisticated institutions are reducing their U.S. exposure to 45-50%. This divergence creates a situation where ordinary Americans bear more risk than professional investors consider appropriate. The real estate impact. As institutional capital flows overseas, it reduces demand for U.S. real estate investments, potentially creating downward pressure on property values that represent most Americans' largest financial asset. Simultaneously, Americans will compete with institutions investing overseas for access to international opportunities, likely facing higher prices and lower returns than institutional investors can obtain. The timeline. What happens next? Based on historical patterns of reserve currency transitions and current institutional behavior, here's how the dollar exodus will likely accelerate. Near term, 2025-2026, acceleration phase. More institutions will follow BlackRock's lead as quarterly performance reports show the benefits of international diversification. The exodus will expand from $2 and $3 trillion to $5 and $7 trillion as institutional investors recognize the trend. This phase will feature continued public optimism about dollar strength, while sophisticated money quietly repositions for long-term change. Medium term, 2026-2028, recognition phase. Media and political leaders will begin acknowledging the capital flight as it becomes too large to ignore. Government responses will likely include incentives to keep capital domestic and possibly restrictions on overseas investment. The recognition phase typically features political scapegoating of institutions in foreign countries rather than acknowledgement of underlying fiscal problems that drive the exodus. Longer term, 2028-2030, adaptation phase. Alternative monetary systems will become sufficiently developed to handle large-scale international trade without dollar intermediation. The dollar will transition from dominant reserve currency to one of several major currencies. This phase features rapid changes in international trade relationships and domestic economic restructuring as America adjusts to reduced monetary privilege, positioning for the transition. For ordinary Americans, BlackRock's capital movement provides early warning about risks to dollar-dependent wealth strategies and opportunities for defensive positioning. International diversification, following institutional strategies by increasing exposure to non-dollar assets through international mutual funds, foreign real estate investment trusts, and commodity-focused investments that provide currency diversification, hard asset. Allocation, increasing allocation to physical assets, precious metals, real estate, commodities, that maintain value regardless of currency fluctuations and provide protection against monetary debasement. Skill and capability development, investing in education, skills, and capabilities that remain valuable regardless of currency or economic system changes. Human capital becomes more important during monetary transitions. Geographic diversification, considering international opportunities for employment, business development, or residence that provide options if domestic economic conditions deteriorate significantly. Early recognition. Advantage. Understanding that institutional capital movement provides early warning allows for positioning changes before trends become obvious to mainstream investors, preserving more wealth during the transition. The key insight from BlackRock's $2.1 trillion reallocation is that sophisticated institutions are already positioning for a post-dollar dominant world. Their quiet exodus provides valuable intelligence about risks and opportunities that ordinary Americans can use to protect and grow their wealth during the transition. The silent vote of no confidence has been cast. The money is moving. The question is whether ordinary Americans will recognize the pattern and adjust accordingly, or remain concentrated in assets that professional money managers are systematically avoiding. BlackRock's message is clear. The era of automatic dollar dominance is ending, and the era of careful diversification has begun. Those who understand this message and act accordingly will likely preserve more wealth than those who assume the current system will continue indefinitely. The exodus has started quietly, but it won't remain quiet forever. The institutions managing America's wealth are preparing for a different future. Individual Americans should consider whether their wealth preservation strategies should evolve similarly.